Okay, thank you. I appreciate the chance to speak here, and I actually made a big point of coming in early, and Miriam worked with me because I saw Andy Watt was in here earlier, and the computer was very uncooperative with him, so I was determined that would not happen to me. I'm going to talk in general terms about some research that I and some of my colleagues have done in some more or less scattered fashion about inequality, and then in particular in reference to the crisis. And I will try to make sure I credit people at the appropriate points. And being from the United States and keeping with the imperialist tradition of the United States, I will disproportionately talk about the United States, but I will try to make sure that I make appropriate references to the rest of the world. Okay, first point, basic story in the United States, and here we differ somewhat from certainly most of the continental OECD countries, continental European, similar perhaps to UK. We've had over 3 decades of wage stagnation, and the story, this is median hourly wages for men. It's actually fallen slightly over the last, well, since '79. For women, there's been a modest increase. We always say, well, we're closing the gender gap, but it's all, or I shouldn't say all, but largely on the downside with male wages falling. So to my mind, this is kind of the basic story if, we're going to talk about, prosperity, people sharing in gains from growth. Obviously, for most people, most of their income is wages. And this story isn't a very good one because, certainly we've had considerable growth since 1979, productivity growth, economic growth, however you want to put it. And in the case of a typical male worker in the United States, you basically have nothing to show. Typical women in the United States have a little bit to show, but not a great deal. Okay, so the question is, why did that happen? What's the gap? And most of the story in the United States until the last decade was actually distribution within labor income. So I'm showing here productivity and real average hourly compensation, and those actually don't diverge that much. If you start at 73, it'd be pretty much the same story from 79. Doesn't really matter what your start point is. But there's not that much diversion between the average hourly compensation. I'll come to compensation and wage growth, the gap between that in a second. But there's not that much difference between that and productivity. And I should point out, I'm a little careful, or I shouldn't say a little careful, I tried to be very careful on how I measured productivity. Oftentimes, well, of course, the standard measure of productivity is based on a GDP deflator. Real wages, of course, is a consumption deflator, so I use a common deflator here. I also take a net measure of productivity, and that really matters for the United States. It matters less for Europe. We've had a substantial divergence between net output and gross output, probably about 3 percentage points over the last 3 decades. So again, that would be just a relic of the data. That doesn't represent redistribution. That simply represents that we have a growing share of GDP going to depreciation. Obviously, no one eats depreciation. So the story here is that there's not much of a gap between average compensation and productivity until the last decade. Okay, and as you see, that begins to open up, and I'll come back talking about profits in a second, but you could see that average hourly compensation begins to diverge from productivity in the last decade before the crisis, and I would attribute that to we had a big increase in our trade gap in the early part of the decade. There's a big rise in the dollar, of course, following the East Asian financial crisis, led to a big increase in the trade gap, large loss of manufacturing jobs. That's when you first start to see a big opening up in the gap between average hourly compensation and productivity growth. And that got bigger, of course, with the crisis, as we lost millions of more jobs, including a lot of jobs in manufacturing and also a lot of relatively good jobs in construction. Okay, and the median, well, obviously that continues to diverge even in that period from the average. Okay, wage share compensation in the United States, at least, a common argument, certainly among conservatives, is really what's going on is not been a redistribution from median workers to higher paid workers or from workers to profit. Really what's going on is a shift from wage compensation to non-wage compensation. You could tell in part that story till the early 90s. That doesn't at all explain fully explain the fact that median wages didn't go up in the 80s, but we did see a big increase in non-wage compensation from that whole period, the early post-war period, through the early 90s. Now, part of that, of course, was the employer side contribution on payroll taxes. So the way our wage data is constructed, of course, employer side contributions to payroll taxes obviously are going to implicitly come out of wages. So those go from about 2% of wages in 1950 to about 15.5% by the early 90s. So that explains a lot of that fall in the wage share compensation. But the other big part of the story in the United States, of course, is health care, that most workers do get health care through their employer. That's becoming a little less often the case now than was true in years past. And with the Affordable Care Act, presumably it will be less true as time goes on. But that still is overwhelmingly the case. And healthcare costs have risen much more rapidly than everything else. So if you're getting insurance through your workplace, that was going to be a growing share of your compensation. So that is part of the picture. To some extent, that was offset by declining employer contributions for pension. And we have just really the collapse of traditional defined benefit pensions in the United States over the last 3 decades. So in the private sector, we're talking about somewhere around 10% of workers now have defined benefit pensions. We often have defined contribution, but in general, those contributions are less than for defined contribution, less than for defined benefit. Okay, labor share of corporate income. Here again, it's giving you this story that if you look at before tax income, there's actually some increase in before tax income that largely goes along with a reduction in the tax rate. So those people who are fans of saying that corporate taxes come out of wages, you sort of have that story with the U.S. It does look that way, you know, at least through the decades from the 60s till the last decade. But again, when you get to the last decade, 2000 till the most recent data, you see that there's a sharp increase, or depending how you put it, there's a sharp fall off in labor share of after-tax income, sharp increase, obviously the flip side of that, in the profit share or after-tax profit share of income. So what we've seen in the U.S. has been, you know, to some extent a decline in corporate tax rates. The bigger part of that story probably isn't so much a decline in the tax rate. If you go back, the corporate tax rate had been 50% before 1980. I'm forgetting which year Reagan changed that, but during the Reagan years, it had been 50%. It's been 35%. But the bigger issue is that corporations have become much more effective at evading it. So our average tax take is somewhere around 20% of corporate profits. So that has fallen sharply. Okay, the next point, there is, and this is getting back to a macro story, there's a very clear link in the United States, and again, I know this is not true for most certainly continental European countries. There's a very clear link between unemployment and wage growth. And we've looked at this. I'm just giving you one regression. I've done some work on this with my colleagues at CEPR, John Schmidt, and also Jared Bernstein, we've done some work on this together. And we've done this with a number of different data sets. Really, it's not sensitive at all to specification. What you consistently find is that low unemployment is associated with more rapid wage growth, particularly for workers at the bottom end. So it's a very clear class story. So when you get to the late 90s, when we had the unemployment rate fall from 6% in 95 down to 4% as a year-round average in 2000, that was the only time that we had wage growth that went up and down the income ladder for workers. That, if you go back from the 80s, early 90s, and then the last decade, most workers saw little or no wage growth. We saw it in the late 90s, and it's very clearly linked to the unemployment rate. So again, I know if you do this with Germany, if you do this with France, you won't find certainly anything close to this level of significance. You can't make it go away in the U.S. data. And again, it's very striking. I just somewhat arbitrarily put this. This was a year of birth cohorts, so we had a trend in there, and this is, I thought, an interesting way to show it. But again, it doesn't really matter how you do it. You find that it has the biggest effect, low unemployment has the biggest effect for those at the bottom end of the income ladder, and it has a modest effect for those at the top, the 90th percentile, I should say, not exactly the top. And it's much stronger for men than for women. So again, you find it with both. In both the distributions for both men and women, the effect is strongest at the bottom of the income ladder or bottom of the wage ladder, but the effect is considerably stronger for men than for women, which, again, for the United States at least, for those of us who are concerned about trying to see wage growth that benefits the bulk of the population, lacking any huge increase in unionization anytime soon, getting the unemployment rate down is really important in that story. And for the moment, at least, unfortunately, it doesn't look terribly likely. but those are very clearly linked. Okay, well, saying a little bit about the rest of the world. Most of you probably came across the OECD's analysis of inequality that came out back in 2011. And we did a lot of work on that, and most of that volume was focused on the 90-50 wage distribution. So they're looking at workers at the 90-50, 90-10. They particularly focused on 90-10. So we looked at that and replicated their analysis, did a few twists on it. And just I want to say a few things about the takeaways on it. First off, they found this. They didn't emphasize this in their write-up, but they found this that really the strongest impact in our replications. We got even a little stronger results, or I guess I should say more robust, because we played with it a lot. You couldn't make it go away. Labor market institutions had a very strong negative effect on inequality. So in particular, employment protection, union coverage. The tax wedge actually had a very strong impact on negative impact. A larger tax wedge was associated with lower inequality. You could say the incentive effect, perhaps. These were annual wages, their calculation. But we did this in hourly in a number of cases. Doesn't go away. So you find there's a very robust relationship that labor market institutions are negatively associated with inequality, and obviously that fits the basic story that you haven't seen the same sort of rise in inequality in countries, the Nordic countries and France, as you've seen in the English-speaking countries where you have much weaker labor market institutions. Education had a strong negative effect. Again, a nice result I think most of us would like to see. I wouldn't accept the view in the United States. We have a lot of people saying, okay, if we just get more people to graduate college. Now, their variable, and the one we worked with, was secondary education, but in the United States, the idea is if we get more people to graduate college, we would reduce inequality, we would stem the problem. I'm not a believer in that one particularly, one reason being that if you look at the last decade at least, wages of college grads have stagnated as well. So if you want to see the winners in the U.S. economy over the last decade, you have to go well above college grads. Basically, it's been people with advanced degrees. And also, I should point out, it's not, we did the analysis, we and my friends at the Economic Policy Institute, Larry Michel and Heidi Scherholz, we've done some joint work on this. Even if you look at workers, graduates with STEM degrees, science, I don't know if everyone here uses STEM, science, technical, engineering, and math, even those workers have not seen increases in their wages. Recent college grads have not seen increases in their wages over the course of the last decade. So you find a very, very small segment of the workforce, regardless of education, has seen the benefits of productivity growth over the last decade. A third point in looking at, again, replicating their analysis and doing some variations on it, you really don't have a technology story. Again, a lot of, it's common to attribute the increase in inequality. You say technology is the main culprit. We've done a lot of work on this. Again, Larry Michel and Heidi Scherholz has done this with my colleague John Schmidt. You really, I think, when you look at the analysis closely, you don't find that. We looked at the OECD data. Their main measure of technology, they use different ones, but their seemed preferred measure was research and development as a share of GDP. And what they found was that they had a trend and a cyclical component. The trend component had no correlation. We found the same thing. So the trend component of research and development had no relationship whatsoever to inequality, this 90-10 inequality. Their cyclical component did. We weren't really that sure what to make of that for two reasons. One is that you could sort of think of cyclical R&D as being related to other factors like the cycle. But the other reason why we weren't terribly impressed by that, you can't explain a secular increase in inequality with the cyclical variable. So we weren't quite sure. They made a lot of that in their write-up, but we really didn't see much significance of that. Again, if cyclical expenditures in R&D are associated with inequality, okay, that explains the change over the cycle. That obviously can't explain the secular trend we've been seeing. One of the things we did was we threw in a finance variable. We threw in our finance variable was very simple. We simply took the finance employment as a share of total employment for the OECD countries, and we found a very strong positive effect. In other words, the larger share of your economy that's employed in finance, the more that contributes to inequality. So fitting with with Jerry's presentation yesterday, and obviously some other research in that area. That was an interesting effect. Again, wouldn't make too much of this because it's a fairly limited data set, but it was striking to see that. The last point, after playing around a long time with the 90-10 wage gap, again, following from the OECD, we realized that that really wasn't most of the story. Most of the story is actually much higher up. So it was, well, what the basic story that you could tell, and obviously, again, some variation across country, but the basic story you could tell is people at the 90th percentile are pretty much holding their own. So I'm defining holding your own as keeping pace with productivity growth. I had someone said, I think that everyone should always get the same gains. No, I'm just saying, who's winners, who's losers. That's kind of straightforward. And, at the 90th percentile, certainly in the United States and in many other countries, what you could say is people at the 90th percentile cutoff are basically seeing wage gains that are more or less in step with productivity. They're not gaining at the expense of people lower down the income distribution. So when we're measuring 90-10 inequality, we aren't measuring the gains of those people at the 90th percentile. We're measuring the losses at the 10th percentile. If we're doing 90-50, again, the same story. And it's really quite striking. Again, it's most glaring in the United States, but it was true in every country we looked at. These are sort of a random cross-section that, as you move further up the income distribution, by the way, this is from the world's, the SES website, Top World Income, if people are wondering the data source, I didn't put it in there. Wherever you look, wherever we have data, those at, when you get to the 99th percentile, their gains were much higher in the 90th percentile, 99.9, they're much higher, and 99.99 higher still. Again, data, there's a lot of problems with this data. I wouldn't make a big point of the gap between 99.99 and 99.9. I mean, some of that will just be, when someone has their big year recorded, you have a CEO who takes his options. Obviously, they're in the 99.99 that year. So I'm not going to go to town on that, but it's clear the higher up you go, that's where the big gains are. Okay, well, getting back to the immediate crisis, and I've heard some very good papers here. I'm sort of beating my head at this point because you go, okay, what else can we do? And I am doing some work that the Macroeconomic Institute's actually sponsoring, that me and one of my colleagues, David Rosnick, are doing some work looking at the impact of fiscal multipliers. But at this point, it's almost like, what else do we have to do? Of course, the big paper here, the Alessini and Ardegina paper, claiming that you could have consolidations be expansionary, and of course that had a huge impact on policy. But this seems to have been about as totally refuted as work could possibly be. And in this case, it wasn't just outliers like us folks here, but I mean it was the IMF that produced some of the best work. In effect, showing that their results didn't really hold. I mean, the IMF 2010 paper was showing that essentially that when you did a more careful analysis of contractions, where you actually had policy decisions guiding the contractions, and they took place in downturns, they were in fact contractionary. And again, being U.S.-centric, I mean, I'd looked at the Alessini Ardegina data. They have contractions. One of their big contractions is the late 90s in the United States. Well, our deficit did fall in the late 90s. It wasn't because we had any sort of consolidation. Our deficit actually went to a surplus. We had a booming stock market. Okay, so tax collections rose. That was the reason for that. So finding that was correlated with growth, yeah. So again, they had a number of incidents like that, and instances like that, and that was exactly what the IMF tried to pull out. And when you pull those out and you actually look at contractions that were designed by policy or consolidations that were designed by policy, those were in fact contractionary, particularly when they took place in a downturn, as obviously is the case now. The 2012 paper was a very nice little paper. They simply looked at their forecast errors, and they found that they were highly correlated with austerity programs, with consolidations, and basically had an implied multiplier of 1, which was considerably larger. In their forecast, they had assumed an implied multiplier of 0.5. So again, it was a very nice piece of work, and I think helped to show the case. And then Sebastian Getschart, who's here, has recently completed a meta-analysis, 104 studies, and the mean multipliers for investment spending, particularly government investment, government consumption spending, was well over 1, and it's higher in contractions than in expansions. Again, everything that we might expect, and again, so you start looking at this point, what else do we have to show? Now, the response from at least some of the proponents of consolidation is, of course, that, well, we have to be concerned about stability, about debts getting out of hand. And there's this very nice paper analysis that Rose recently put out looking at debt burdens, debt to GDP ratios, and interest rates. It was following off work from Kutlikov. I forget who his co-authors were, but Kutlikov. I have the red and blue pulled out. I mean, Rose did this, not me. Kutlikov, when in that paper they didn't pull those out, so they go, oh, look at this. You know, we have much higher interest rates in countries that have debt to GDP ratios. Well, it turns out that's all driven by the euro. You know, these are countries that don't control their central bank. So when you look at the countries that have their own currency, the United States, Japan, Canada, UK, there's no relationship. You'd have to beat up that data really hard to find any relationship between interest burdens and between debt burdens and interest rates. It just is not there. So, you know, it's, you know, as I say, I don't think you have much of a case there. You could say, well, the countries in the euro don't have a choice. Well, they don't, but that's a policy decision by the European Central Bank. So, you know, that's, you know, again, a policy decision to force austerity. Now, the point, you know, one of the points, I mean, obviously it's bad why you experience it, but, you know, one of the issues, this has been raised perhaps best by DeLong and Summers, one of the issues that, you know, we have to look at is, you know, the issue of hysteresis, that you're going to have a prolonged loss to the economy as a result of this period of severe stagnation, high unemployment. Now, what I did here is a very, very simple exercise. I just took a look at the growth projections from the IMF in 2008. This was the spring of 2008, so depending when you date the recession, it's different every country, but before the big financial crisis. So before they anticipated that. And these are their projections for 2013, so implicitly they're always projecting based on potential GDP. So it's looking at actual GDP in 2007 against a projection made for potential GDP in 2013. And then I just took a look at their recent estimate of potential GDP for 2013. Those are the blue lines, and saying how much growth that implies from the actual level of output in 2007. And what you could see is in every case, it's considerably less. In other words, they're assuming that potential GDP is going to grow much less relative to 2007 GDP than they had back in 2008. I'll admit to censoring this. Israel showed greater growth, and attribute that to Stanley Fischer's brilliance or whatever, but I just pulled that one out. So if someone wants to go back and look, you'd find that. So, you know, what do we say about this? Well, one thing you can say is that in 2007, economies were operating way above potential GDP. You could say that, and also the IMF wasn't smart enough to know that, because they made projections, in fact, assuming they were at potential or near potential. You know, the story there, you know, you really have to sort of scratch your head. You know, a country could be, you know, 1, 2, 3% above potential GDP. Do we really think that, you know, Greece, that Canada, that all these countries were, you know, 5 or 10 percentage points above potential GDP? I mean, I really don't think that's a plausible claim. But that's really what you would need to make sense of this sort of change, you know, taking it from that side. The other side, of course, is that, you know, they've underestimated potential GDP in 2013. And certainly I'd be willing to make that argument. So in other words, you know, we know the way they do this. They're looking at rates of inflation, or the slowing of the rates of inflation, and imputing, you know, an effective Nehru and a potential GDP from that. So you could say that that methodology is rather crude, and, you know, it's led them to underestimate potential GDP. I think that's probably in part the case. But the other part of the story is that we've actually seen a real loss in potential GDP. And it's not hard to make sense of that we have a lot of workers that, you know, had we maintained sort of normal rates of unemployment, normal rates of output, they would be in the workforce, they would be productive. They're not in the workforce, and many of these people may never work again. And as a result of that, we're seeing a very big loss in potential output. Also, because we're operating so much below potential, we're not seeing the same rate of investment as we might otherwise see. So as a result of that, we're seeing an actual decline in potential GDP relative to where we would have been had we not had this long stretch of austerity. And, you know, these numbers are really incredible. I mean, you can take Greece as just being the extreme case. We're looking at a number where they're projecting 15%, that their potential GDP is almost 15% less than what their actual GDP was as of 2007. I mean, it's kind of an incredible number. And there's several other countries, Ireland, you know, mostly crisis countries, Ireland, Italy, where you have that same story. And it's really quite striking. But even the non-crisis countries, UK, for example, they're showing a potential GDP that, eyeballing here, it's about 1%, 1.5% higher than it was in 2007. It's pretty hard to, I think, tell a serious story if we think that UK's GDP in 2007 was near potential, that its actual underlying rate of growth was about 0.1% a year. I think that's a little hard story to tell. The other point I should make on this is that, when we look at IMF, and it'd be the same story if we got the OECD numbers, by the way. They wouldn't be exactly the same, obviously, but the same story. When you look at their estimates of potential GDP, these are not just calculations that they're doing abstractly. These actually guide policy. So even if they're completely off the mark, they're guiding policy both in the sense giving direction to central banks when it would be appropriate to start tightening, and also, when you're looking at the crisis countries and they're setting deficit targets, those deficit targets are, of course, based on, or for the most part, I'm not going to say in every case, the most part they're based on structural deficits, which, assume a potential GDP. And if they've assumed a potential GDP that's in fact considerably lower than what the true potential is, that's going to have real impact on the policies being pursued by those countries. There'll be a lot more austerity than need be. So my takeaway from this is that, no matter how you look at this, we're looking at not just, at this point now 5 years of economic downturn, but we're likely to see enduring costs long in the future. And it's a bad story both in the sense, obviously, we're losing output. We're not going to get that back. We're never going to make up the output that we didn't have in 2009, 2010, 2011, and 12. But we're also likely to be paying costs for this, even if we envision these economies recovering, 3, 4, 5 years out. That would be optimistic at this point. But we're looking at a very long-term cost on this. Okay, well, let me just jump over and throw in my sort of catch-all things that I like to talk about. And I'm just going to abuse you for a few minutes in the time I have left with some of the things that I think we don't talk about enough, and I think are very important as impediments to wage growth. Jerry, of course, did talk about the finance, a very good talk yesterday. I think finance, I think the points Jerry was making is very well taken, that finance is, I think, a serious impediment to growth. It seriously leads to growing inequality. There was a nice paper that came out from the Bank of International Settlements, I think it was last year, by Caschetti, and I'm forgetting his co-author, that showed is a very nice U-shaped curve between growth rates and the size of the financial sector, that as the financial sector gets larger, at least initially, it's associated with more rapid growth. So the idea being that you have countries that have poorly developed financial sectors, that impedes growth. As they get more developed financial sectors, that increases their growth rates. But then when they get very bloated financial sectors, a story that would certainly be true of the US, UK, some of the other OECD countries, that slows the rate of growth. So that fits well, I think, with the story I believe, and I think the story Jerry was telling. We've done, I was just playing around with one of my colleagues, Helena Jorgensen. We did a simple analysis. It didn't really have enough data points to make too much of it. But if you look at transactions cost and relate those to growth, you find that countries that have the lowest transactions cost, this is for financial assets, had lower growth rates. So again, I won't make a big thing of that because the degrees of freedom here were not a lot. But in other words, controlling for some number of controls that countries like the United States that has among the lowest transactions costs in the world, they had lower growth rates than countries that had higher transactions costs. So the idea being that having very low transactions cost allows more resources to be used in the financial sector, and it's pulling resources away from growth rather than going to productive sectors in the economy. Patents, I think are a very big deal, both in the sense of being a drain on the economy and also being associated with inequality. We were looking at the OECD data. We could find a number of measures of patents that were associated with rising inequality. We didn't make too much of that because at the end of the day, we ended up feeling that we didn't have a very good measure of patent density. I mean, there are measures of it, but they seem rather arbitrary when you look at them on closer inspection. But just to give you an idea of the amount of money involved, and again, I'm being U.S.-centric here, but I think it's appropriate. In the United States, we spend about in excess of $300 billion a year on prescription drugs. That's about 2% of our GDP. We'd spend probably a tenth of that, maybe less, if we just had a free market without patents and related protections. So we're talking about somewhere in the order of 2% GDP just for prescription drugs. So that's about 20% of corporate profits, after-tax corporate profits. That's real money. Now I'm saying, the United States, where, our healthcare system's a cesspool. We pay twice as much for our drugs as anyone else. So we definitely are an outlier in that respect. But on the other hand, whenever we sit down and negotiate a trade deal, the Trans-Pacific Partnership, the EU-US Trade Pact, guess what? We're trying to impose the same sorts of rules on other countries. So I think, and we do. We often do, yes. So I think that's, there's a lot of money at stake. There are other ways to support biomedical research. I always say this to people, and they go, well, how can you support that? In the United States, we spend $30 billion a year on biomedical research through the National Institutes of Health. You could spend more. You could do it through other channels. I won't go into detail there. Just want to say I think it's a very, very big issue, and I think it deserves more attention. Copyright's the same sort of story. What I'm just struck with copyrights, when we have material that's available for free, there's all sorts of things you could download on the internet. A friend of mine sent me a blues. I discovered YouTube. They sent me an old blues performance, and then I spent the rest of the evening clicking around, finding I could find just thousands of old blues performances on the internet. Well, you get that stuff for free. It's never recorded in GDP. And you lock it up as copyright that will be recorded. That's definitely an asymmetric situation. There are ways in which you could account for that. I'm not going to go into that, but the point here is, when you lock something up as copyright, I think that's in general going to be lowering GDP. And also, again, the people who get copyrights, I know there's the starving artist that gets $50 a year in royalties. Most of the people getting that money are not poor. So I'd say it contributes to inequality. Last point, corporate governance. Again, more U.S. story than elsewhere, but again, our crimes tend to migrate. The United States CEOs, major companies, routinely get 8-figure salaries, sometimes 9-figure salaries, and I'd really say, you could find people try and tell you that really is a market outcome. I don't think that makes sense. Essentially, we have a corporate governance structure where there is no check on CEO pay. The people who are supposed to be controlling CEO pay are corporate boards of directors who are usually got their position as directors by virtue of having a connection to the CEO. So we don't have serious checks on CEO pay. And that's important not just for the CEOs. You can go, okay, well, how many CEOs are there of Fortune 500 companies? I mean, we know the answer to that, 500. But the thing is, it sets pay scales throughout the economy, that you have, heads of nonprofits, universities, charities. They invariably say, look, I'm running a big organization. If I were running a company this size, I'd be getting 10, 15 million. And you start to see the same sorts of salaries in these other institutions. So I think it is very important. And again, naturally, there's efforts in Europe, certainly by your CEOs, to try and copy U.S. corporate governance structure for the obvious reason. So again, at the moment, this is primarily a U.S. problem, but I think that is a problem that can migrate elsewhere, and something that I think deserves more attention. I think we've generally given that. So just to sum up, I wish I could be optimistic that we're about to see a boom of government stimulus programs or investment programs, if you like, and we'll get back to full employment and we'll see equal wage growth. Unfortunately, I don't think the prospects of that are really good right now. The obstacles obviously are political. It's not an economic issue. And the implication, certainly for the United States, but really at this point, I think for most OECD countries, is a pretty bad story for most of the population. So the other people other speakers will be more optimistic, I'm sure. Thank you.
Thank you very much.